Okay. Yeah, I want to make a point in regards to the discussion we had before starting the webinar. Our job as technicians are to, I don't know, cognitively trade the trend. Some people will counter trade the trend and so forth, but generally speaking, most traders like to buy in a rising market. They like to fall in a falling market. They'll have slightly different techniques, but generally speaking, that's what people are trying to do. There are a few that will counter trend trade and stuff like that, but generally speaking, okay? Does everybody agree with that simple point? Or at least they should be trying, right? All right, so I know many of us want the Euro USD to come down. That's fine. And that might be based on fundamentals and your bias and stuff like that. Okay, that's cool. But the reason you use technical analysis is to enter your trades in the direction of your bias. Okay? But you have to pay very close attention to flow, right? Where's the money going? You want Euro USD to come down. Probably everybody on the planet wants Euro USD to come down. Do you think Draghi, the head of the ECB, wants the Euro USD to come down? And he's investing billions, tens of billions of euros, and the market's not coming down. And you're shorting Euro USD blindly? Is that right? Well, what happened to this technical analysis we were using? So we will go over yesterday's head and shoulders pattern that we actually set up weeks in advance. It didn't work. You're allowed to lose some money. That's what investing is. But do you just keep shorting, keep shorting, keep shorting, keep shorting, keep shorting? Okay. Do you? Well, why would you keep doing that if you were wrong down here? Remember, our trade plan was to sell here if we got a reversal pattern. Now, the problem is we didn't really get a reversal pattern. And if you recall, and I'll go into the other chart where we had it designed, but we had this fibbed up. If you remember, yesterday's trade plan was a 1, 2, 3 reversal using a 15-minute or a 5-minute chart this way, right? And the basic target for yesterday was this area here, right? Okay, that was yesterday's simple plan, right? There was the plan will sell here, sell here, sell here, sell here, sell here. Look, if the reversal pattern doesn't appear on the small time frame, this one here on a 5-minute chart, and the one that's on the 4-hour chart fails, at some point you have to ask yourself, was I wrong? Did things change? Maybe you took a shot up here. That's fine too, if you get the reversal pattern on a small time frame. And it seems to me you might have, but probably not have, but you could still have been a bit aggressive. But, at what point do you recognize that this was not a lower low? And we did kind of talk about that. I wished it did come down a little lower, right? Remember? It was about 80%, but it wasn't quite 100%. It doesn't mean you throw it away, because, patterns are rarely perfect. But, it adds a little degree of risk. But at some point, as a technician, you have to pay attention to the technical analysis. This is not a bearish trade. Okay, so let's talk about that briefly, and then, well, you know what? Let's officially get going. Okay. My name is Wayne McDonell. I'm the Chief FX Market Strategist for TradersWay.com. Thank you for being a client. We do these sessions every single day, Monday through Thursday, here at TradersWay.com, and on Fridays at FXStreet.com. TradersWay is an ECN, which is very nice. TradersWay offers their clientele Forex, energies, metals, indices, and binary options. That's like taking a kid into a candy store. When the sessions are over, I immediately upload them to youtube.com, and I'd appreciate it if you spent 1 minute of your time and leave a comment and let us know what your takeaway was. Take some notes while we go through the day and just jot a couple of sentences down. What did you learn? What did you like? Etc., etc. Let's get going. We've got lots to talk about today. Let me remind you that trading and investing is risky and not appropriate for everybody. Your past performance, good or bad, does not predict future results. So always stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. Okay. So let's talk about what's going on. The Euro USD would be coming down based on at least one market participant's behavior, and that would be the European Central Bank, Mario Draghi et al. Now they're doing quantitative easing. What would they like to see for the money they're spending? Because remember, they're not actually printing money, they're spending money. Okay. They want to see asset prices go up. One way to do that is have the euro weaken, so it take more euros to buy something. That would make prices go up, right? So asset prices would go up, and you would see, for example, the DAX should be going up because those are German assets. We're still right on the precipice here of danger. This little move here, I'm going to move to the right. It still looks like an inverted head and shoulders pattern. Okay. The other one was going to be a 1, 2, 3. This looks, so this needs to go up. Okay. This needs to go up, like, would you say soon? What happens if we drop below this 382 now and we don't get the inverse head and shoulders that's set up here on the German DAX, the German stock indices? Well, if it comes down, I think it's going to come down farther. And no, nobody really wants that. Okay. The next one is 50%. That's pretty good. Or the 618, which we already have marked. Okay, that's fine. I don't want it to come down any farther than where we are now. Okay. So I would really like this head and shoulders to rise. Now, see how support becomes resistance, and then resistance becomes support, and support becomes resistance. So look, if it drops farther than this today, this is going to hurt. It's going to hurt someone that is spending billions and billions of dollars making it go up. But so that messes up the euro. If the German stock market's falling, are people buying European stocks? No. And if you're a foreigner and you're not buying stocks, you're probably buying something else, right? Are you buying bonds? No. If you look at bond yields right now, bond yields are high, which means they're taking their money out of bonds, which I'm okay with as long as they're buying stocks. But they're not buying stocks either, because you can see this is coming down. So it seems to me a lot of foreigners are withdrawing their money. So what's happening to the euro, just the euro? The euro is weakening, isn't it? Well, you say, Daniel says up. You're thinking euro USD. I'm just asking euro. Euro is weak. Okay? So you're right in regards to euro USD. Well, yeah, you mean it goes up. Yeah. So anyways, just the euro itself, that one currency, you know, well, let's flip it over to the other side, okay? Because there's so much in my head, it's bobbling around. The reverse of what's going on is that the reverse of what's going on is in regards to retail sales, and that's what that we were talking about just a few moments ago. Someone had mentioned, I think it was Buzz, that you know, that really messed up our head and shoulders pattern, which we'll go back and review in a second. Yeah, when we get bad news about the U.S. economy, the dollar is weakening because the dollar is weakening because market participants have been preparing or even front-running a rise in interest rates in the United States. And they've been terribly, terribly wrong. They've been way too optimistic or aggressive about that. And I don't know how they get to that determination. And when you listen to like CNBC and Bloomberg, you hear it all the time. Like the Fed just has to raise interest rates. They're being dangerous, even. And I don't know where they get this information, but it ain't happening. And they're starting to like wake up. The degenerate gambling on Wall Street is starting to hurt, right? So they're getting out of that trade, and when they're front running the Fed raising interest rates, they're buying dollars. And so just too many dollars were bought. So that artificially creates a strong euro because they were selling euro to buy the dollar. So now they sell the dollar and have to offset that with buying euro because they were short euro. So that has to be offset. So you get the strong euro. And I'm telling you, Mario Draghi must be sweating bullets. Because he thought for sure the euro would be weak by now. And he was probably really happy in the beginning, right? But the euro USD fell too far too fast. So how far can it go up? Well, that's the ultimate question, right, Mark? And I'll answer that. It will go up until we hit massive resistance. Not just resistance, an area in which bears want to get back into the short for Euro USD. Okay? And then we get a reversal pattern. It could have been yesterday. So let's go back to yesterday's thing. It could have been yesterday. Multiple reasons said we were at resistance, but nothing fundamentally has changed. And our plan yesterday was this one. This top didn't exist yet. Hang on. Right? Oh, you know what? I probably have an image somewhere. Anyway, oh, get me a ticket for an aeroplane. Here it is. Okay. Anyway, oh, get me a ticket for an aeroplane. Okay, that's what we had yesterday. Now, the peak was high, the drop was significant, and the hope was the peak to drop was a crown formation. Okay? And if it was a crown formation, it's a head and shoulders pattern. that would then produce a lower high, which for some is just a 1, 2, 3 reversal pattern. For some it's a head and shoulders pattern, but the lower high would predict a lower low. Hang on. I was just trying to start my drawing tool, and all hell broke loose. Okay, there we go. So the plan was this. Okay, that drop's too big. So we didn't predict that. I don't know how you could. Okay, couldn't predict that. But once we got that, we said, aha, we're here. Our plan was let it come up here. And then when we got up there, drop to a smaller time frame, look for a reversal pattern. And if you got one, you would sell it. The first target would be here, then that would probably bounce up, and then here, and that would probably bounce up, and then we'd be down to here, okay? Did that happen? No. So you're a bull, or you're not selling yet. Do you understand? That's how technical analysis helps you. So you need to back off and recognize that, okay, you have your bias, you have your strategy that you want to carry out, right? You want Euro USD to fall. So now you use your technical analysis to find your entries and exits. But a seasoned trader will recognize when they're wrong and just back off. Yes, very well said, RP. You're a bear, but on the sidelines. And you need to walk away. You shouldn't have a ton of losses on Euro USD. Someone had mentioned, you know, floating losses and stuff. Floating losses? What the hell are floating losses? I've never heard of them. Right? Floating losses sound like a couple of things. One, you threw down a bunch of trades, and then once you got a losing trade, you threw down another losing trade, and then you threw down another losing trade, and then you threw down another losing trade. And the other thing it means to me is you didn't get out. I don't mind you losing, but having 5 or 6 or 7 losers, okay, that's a problem. And then second of all, if you're still in those trades, well, what happened to your risk management? Risk is such an important topic, guys. Okay? Risk is such an important topic that even when you're filthy, unbelievably successful, and you got like 3 years of trading performance of above average results, do you think potential investors are thrilled? Like the money is just going to jump into the boat, right? The money from investors going to rain from the sky? The first thing they say is, you've made too much money. Very often that's it. They're like, ooh, I don't like your results. Honestly, you could have too good of results, and they'll say, well, you're taking too much risk, I'm not interested. And you're like, whoa, right? But second of all, let's say you have decent results, and you have long history of decent results, they're still going to do risk-adjusted performance analysis. It's always about risk, even when you're a good trader, risk. So to have like, you know, you're like, I'm bearish on the Euro USD, and, you know, I'm selling this higher high because of the failed head and shoulders pattern. Like, at some point, you just need to take the loss. You need to say, holy crap, I'm wrong in this one, and back off. No more, and there's no such thing as a floating loss. What did we talk about yesterday? Enter a trade, move your stop to break even. Enter another trade, move your stop to break even. Enter a trade, move your stop to break even. Let those float. How do you get 100 open positions? One at a time, and each one of them should be profitable. Not 100 losing positions, right? So I'm drilling down on this because it's such a key concept. The great traders know exactly when they're wrong and they get out of the position. Okay? There is no such thing as a floating loss. Oh, well, I got these 7 trades open. You know, I'm hoping they're going to come. That's vernacular that doesn't exist in a successful trader's world. He would say, oh, I don't even know what that is. What is a floating loss? You'll have to teach me, right? You can have a losing trade, but floating losses, oh my gosh. So look, guys, technical, our trade here yesterday, let's say you shorted here. You're out here, right? And you're done. Your next one would have been London Open, let's say, and you find the market up here, and you try again, but you should be nervous at this point. Okay? Okay, because, you know, we're riding the... So let's do this. You see this 2155 crossover? The market is bullish, technically. That gives bulls the permission to buy. Right here. Okay? Retail sales came out. Bad number. Euro USD goes up. You're wrong on the head and shoulders. We were very, very, very potentially right. I'll tell you what. If we tweaked one thing, and one thing only yesterday, if retail sales came out good, or even okay, this would be down here, and we'd be doing this today. We would have been right. Euro USD would have come down. There's no doubt in my mind whatsoever. But efficient market hypotheses indicates that the value of an asset is directly impacted or even created by all known information. And what's new information has been added or to the public, the value will change. And what happened yesterday was no June interest rate hike. Maybe not even September. That's what happened. So let's talk about one thing. Why would the Fed raise interest rates? Just not this meeting or that meeting, just any meeting. What would make the Fed raise interest rates? Help me out with the fundamentals. Help me understand. Inflation, what is that? Sounds very abstract to me. Rising prices. Prices going up fast. Could. How do we measure that? Well, how about this? If they use all their PhDs to review all kinds of fabulous data coming in from all sectors of the economy, and they find out that people are getting good jobs, they're feeling very secure, and they're spending their money, and demand for products are going up, and prices are rising. Is that just like a fair description of what they would want to see? It's not just jobs, right? It's not just this, it's not just that. But people have jobs, there's credit available, the consumers are confident, they're spending their money fast or even faster than they're making it. and that money is going out throughout the economy, and prices are starting to rise. Prices of homes, prices of TVs, prices of food, prices of energy, because gasoline prices are up because of demand. Okay, so retail sales are important because they measure a lot of things. Now they can be highly impacted by gasoline because they're not measuring gasoline sales. They're measuring gasoline prices because, like they're not measuring based on how many barrels were sold or how many gallons of gas were sold. They're measuring the receipts at gas stations, for example. So if gasoline goes from $2 a gallon to $4 a gallon, a lot of people will say, see, the retail sector is doing great. And they're like, not really. They're just people are paying more for gas. So anyways, but that would be created from demand, sometimes supply. But a bad retail sales number says people are not spending money. Well, why not? Well, we don't know. We don't know why not. It could be a plethora, a cornucopia of possibilities. But what it does mean to a lot of market participants is the Fed's not going to hike, dollars weak. That's it, done, next. So this is where if you're still shorting yesterday's trade plan today, you're missing the fact that yesterday's trade plan failed. And I don't mind if you were ready for this or you took a small nib there, but at some point you're going to have to say to yourself, this is an up move. So to wrap this topic up, if you're a bear, let this go up 115, 118, 118.88. 120.50. I could not care less about what the price is. That's Draghi's problem. Okay? Let it go up ever if you want. If you're a bear and you think this is fundamentally going to reverse, wait until you get that. Very similar to how we handled this situation. But new information entered the market. It affected the flow. Enough said, that's dead. I am going to just either stay out or even buy dips until we get a lower low. Then what's my job as a technician? All that says is get ready. My fundamentals might be kicking in. My job as a technician now is to sell lower highs, right? Sell the rallies. Okay? If that sets up and I get a scenario like this, I stop selling. Why? That's what technical analysis does. Okay? And I want you to erase floating losses from your vernacular. Your brain, just delete it from your brain. You're like, somebody told me about that once, but I just don't understand it. Okay? How about this? Ask yourself the next time you place a trade, ask yourself if you're a degenerate gambler. Is this a bet? So you're getting ready to sell at 115. I can taste it in the air. If you do that, you might be right, but you're gambling. I bet you it can't go any higher. I bet you at 115 will hold. Does that sound like a professional trader? Is that how you're going to base your career? The next 10 years of trading, you're going to sell rallies at resistance. Think about it, right? Am I hitting nerve yet? The market's rising and you're going to keep selling a rising market. You want to make a career of like trying to push rain back up into the clouds. Well, good luck with that. Right? So just be very, 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 very careful. So let's say you do want to sell at 115. Now I got you really scared. Well, good. At least you're listening, for crying out loud. All right. So it's up here, basically, right? We have this marked out from a while ago. How do you do it, Wayne? Well, let me tell you, my friend. If price comes up here and you get a reversal pattern, then sell the next lower high. Okay? I'll tell you what, I think the market's going to take a while to reverse. So here's my guess, if you don't mind, that it does that, then it does a double top. It does it again. And it might like double top on a 1 hour and then need to double top on a 4 hour. Okay? Because clearly, we're going to need to get a lot of market participants on that trade. This is going up despite the best efforts of a lot of market participants, including a central bank. One other thing is I would like to see the DAX going up at the same time the Euro USD is coming down. But because it should, right? With weakening prices in euro. Not prices, valuation. So this should go up with quantitative easing. Now, we've already had this identified a long time ago. It's just taking a while to head up. Now, if you think it's going to come down all the way down to the 618, someone said 50%, someone else said 618. Hey, how about 786? Oops. It's all possible. 786 looks the best to me. Tell me about this situation. Talk to me, Goose. It's not that they're buying the DAX. It's that the euro's weak, or quantitative easing is affecting it. Asset prices generally should go up because the DAX is priced in euros. Okay, it's not necessarily a supply and demand for from foreign investors. Just let the Europeans fix the problem. Okay. So, Well, how about this? Let's change the scenario. What's the Euro USD doing when the DAX was doing this? What was the correlation? It was highly inversely correlated. Okay, Euro USD was coming down like a ton of bricks during this period, right? Okay, what's happening now? What's been happening in this period since the beginning of April? What's been happening to the Euro USD? Highly inversely correlated, right? So you see my point now? What do you think we need to see before the Euro US starts coming down? Correlations can change, and they do change, but wouldn't that be something that we might want to pay attention to at the bare, at a bare minimum, at least pay attention to? Okay, so the DAX is going up, but the stock market's pathetic. As a percentage of the economy, stocks are useless. It's a joke. Hey, do you want to buy my Amazon.com stock? Okay. I mean, it's nothing compared to the economy. And it doesn't do Amazon.com a dang thing. So if the stock market's going up, bonds are falling, maybe. Who knows? So let's just kind of look for that. It's not that it might not happen, but it did happen. Past performance doesn't predict future results, but what is technical analysis? See, that's the weird thing about our industry, guys. There's so many things that are contradictory. Required by the government to tell everybody you meet, past performance does not predict future results. And then you're like, but I use technical analysis because it's the study of past performance, and I use it to predict future results. But see, now if you're an efficient market hypotheses person, which anyone with an education in finance that has studied stock valuations and bond pricing and Black-Scholes option pricing tables and stuff, they all get together as a crew and they say, technical analysis is worthless. It's rubbish. Honestly, they think it's stupid. And prices are set by a random walk, and you couldn't possibly predict the course of the future based on price. But yet, I don't think any of us believe that. So, but I've hung out with professional traders, and they've laughed me out of the room because I do two things. One, I use technical analysis, and two, I'm a currency trader, and they find those the two most ridiculous things on the planet. But to combine them into a career, they just thought was silly. One time I was at a professional hedge fund conference in New York City at a very high-end club, and I sit down, it's like lunch break or something, right? And I'm looking for a place to sit and eat my sandwich, and this guy was sitting outside at a table, so I come up, I'm like, hey, do you mind if I pop a squat? He's like, yeah, help yourself. So anyway, so I sit down, and I'm like, hey, what do you do, huh? And he's like, I'm in merger arbitrage. And he's like, what do you do? oh, I'm a foreign currency trader. And he's like, oh, I couldn't possibly do that. It's just way too hard. Yeah, it's an event-driven strategy. It actually used to be one of the most common trading strategies on Wall Street in the 80s. In fact, the movie Wall Street is about that. So anyways, so this is why we have been doing this. I don't know if you get it. This is why I like going over things from every angle possible. This is one reason why we've been watching the DAX all this time. How often have I been showing the DAX, let's say before April? Not very much at all. You might not have even seen it. All of a sudden, April shows up and we're watching the DAX and we're doing fibs on the retracement. Why? Because it'll probably affect the Euro USD. And so one thing that we're looking at, well, look at all the pieces. Commitment of traders report, okay? Technical analysis of the Euro USD itself, but we're also looking at intermarket analysis. And we were in a situation, yesterday for this pattern to develop on the DAX, right at the same time that the Euro USD was doing an inverse and a head and shoulders pattern there, right? Euro dollar was set up to do this. At the same time, the DAX was set to do that off of EA2. Perfect storm, right? Well, Wyatt, there's only so much we can do today, all right? But yeah. Yeah, no worries. So anyways, so it still could happen, and you might find the 115 area, right? On Euro USD, right? And the DAX could still do this, right? What happens if the DAX drops below the 382? Stop selling Euro USD as it's going up. You need to adjust. You need to say market conditions have changed. New information has become available. Market participants don't agree with my point of view. Or in this case, Fernando says sell rallies here. Okay, well, if you're a DAX trader, I don't trade the DAX per se, right? That's not why we're here today. But I could say, you better back off, dog. You might be seriously wrong, yo. Right? You need to just, red flags or something, right? It's vitally important to know when you're wrong, guys, because you want your losses to be small. And you don't want a whole lot of them either, right? It's okay, you're going to be wrong a lot, but you should be right a lotter. So when you're wrong, just back off. So again, what am I looking for? I'd like to see the DAX go up. I'd like the commitment of traders report to stay essentially the same. I would like this to go up to, let's say, 115 if that's what you want to do. And then I want to see it make a lower low, lower high, and then I'm going to drop it like it's hot. After it's reversed. Buzz? I don't want you to reverse the market. I'm hoping Draghi is sweating bullets. And I hope there are people banging on his office door every day. Why is the euro going up? Why is the euro going up? What are you going to do about the euro? What are you going to do about the euro? And he does something to weaken the euro. Now here's a man that could just take the mic and just say something. Do you understand that, guys? He could take the mic today at a luncheon for finance people at the, International Brotherhood of Finance Professionals in Barcelona. He's in Catalonia because he likes the food, right? And he picks up the mic and he says, blah, 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 blah. Euro can come down. With a bat of his hair and a wink of his eye. Right? So why not, let's wait for that to happen. Okay? BFB. Yeah. Okay? If you understand, say aye. Thank you, guys. And then I want you to think about this or write it down, make a note mentally or physically, spiritually, however your soul tends to work. But you need to sell after the market's reversed. If you're a bear and the market's going up, let the market reverse. Let the market reverse. Okay? If the market is bearish, you sell rallies. If the market is bullish, you buy dips. I've never once said, if the market is rallying up to new highs, sell it. Right, Buzz? And I've never recommended floating losses, so don't do those things. Stop it. Hey, stop it. Well, you're only stupid if you do it again. Okay? Yesterday, let's say you were inexperienced. Okay? Right? Tomorrow, you're stupid if you do it. Okay? And look, I want to be clear. We set this up to fall. That's cool, man. That's cool. It didn't work. Retail sales killed it. I didn't see an entry, but let's say you did. Fine. You shorted that red candle. You were shorting here yesterday, let's say. Okay? Good trade. Honestly, that's a great trade. Right? That's a good trade. Very well done. You lost money. So what? What's your problem? I lost 50% of my family's net worth. Well, dude, you're over leveraged. That's a whole different problem. So if you shorted there, that was a great trade. High five. You lost money. Oh, that sucks. What happened? Oh, I got killed on this crazy bad retail sales number. Oh man, that sucks. And then you move on. Then you might have traded up here. Okay, that's aggressive. Why? I mean, it's a double top, but I like to double top with a reversal pattern, right? Just like I did before. I want to see reversal patterns at resistance, not just at resistance. But if you took a shot in there, it was Asia, You know, it was Asia kind of thing, I think, right? A bit aggressive, but again, you would have known when you're wrong. But I don't want you to get in that habit. Okay? This was a great trade that lost me. Excellent job. Do it again. Do it again 1,000 times over. Okay? Everything else pretty mediocre. This was plausible. You had a shot. Again, it didn't work out. But there's no floating losses. There shouldn't be 7 trades in here. This shouldn't be a short in here, right? There shouldn't have been a 618 or a 786 type trade. Double top, I get it, but you know, it's a bit of a gamble. I mean, you're gambling. That's all. And I don't want that for you. So I doubt you'll be short today. Okay? I doubt you'll be short the Euro USD today. And maybe even this week. Yes. Okay? You had your shot yesterday. Didn't work out. Move on. Trade under your own conditions. Right? Under your own terms. Dictate your own terms. Okay, USD CAD. What do you want to do here? Sort of, right? Just measure it any way you want. That's what your is. But it doesn't seem like a buy to me, right? Does it look like a sell to you at the moment? All right, well then create your plan. What are you going to do tomorrow? You shouldn't be making this up on the fly. You should say at least it's a downtrend. I want to sell it high. It's on a low end of a Stokes cycle, so I'll catch the wave tomorrow.
Month expected 0.1%, core expected 0.1% as well. Year over year, PPI expected minus 0.8%, with the core expected at 1.1%. Also got Canada housing price index for March expected month and 1.3% year over year. The weekly initial jobless claims, as well as the PPI in Canada data in just a few seconds. Claims 264,000 below the 273 expect. Continuing claims 2.23 million is in line with expectation. Prior by slightly higher. PPI at minus 0.4% is 0.5 lower than expected, with core at minus 0.2%, 0.3 lower than expected. Year over year, PPI at minus 1.3%, the minus 0.8% expected. Core at 0.8% is 0.3 lower than expected. Canada new house price index at 0.0% is 0.1 lower than expected. Year over year at 1.2% is also 0.1 lower than expected.
That was brought to you by TradeTheNews.com. I've been using their service now for probably eight years, maybe. Fantastic service. Apparently there were some orders in the market at the high end. Yeah, you have to apply. It's for professionals only, right? Yeah, tradethenews.com. Peter, did they say why? Do you want a hint? Now you have to pay for it. It's a couple $100 a month, right? You're going to have to pay the couple $100 a month. I don't make any commissions or anything. I just know them. So I just want to make sure. All right, well, it's $200 a month, maybe $250 or $300. I honestly don't know. If you tell them that FX Bootcamp sent you, because I'm the founder of FX Bootcamp, they'll let you in.
So we saw some pretty broad declines across all categories, most categories in the PPI data. Next, food and energy at minus 0.2%. Trade weighing on that, down 0.8% in April versus March. Personal consumption, we saw a 0.8% decline in goods and a 0.1% decline in services. And finished goods down 0.6%. So it was not just energy weighing on the weaker PPI figures.
So PPI is down. It was in fact negative. So here's food for thought for those that have the floating loss problem, the problem of selling Euro USD as it's rising. If you're going to do that, and I've already done videos on this 2 or 3 times, but let's discuss that scenario one more time. Use binary options to do that scenario. Okay? Think about it. If you're right, you'll get paid. Even if you're a little bit right, you don't even have to be a lot right. You'll get paid. And if you're wrong, you can't hold a floating loss. Because an option is just that. It's the right but not the obligation to buy the currency pair. So if you're wrong and it doesn't go down, you don't have to buy it at the higher price. And the amount that you paid for it, which is called your premium, expires worthless. It just costs you that. Or just whatever you paid to buy the actual option, or actually the right to buy, right? It's just a right. So you say, you want to purchase the right to buy the Euro USD lower than, and then you pick that price like lower than this. All right? And I'll pay $25. And in the future, at a time of your choosing, or even sooner, if prices lower, like down here or down here or down here, you have the right to buy this at a low price and you'll make money. Because you're saying, so in that case, you are buying a put, which says it's the right but not the obligation to buy the Euro USD at a lower price, and you're guaranteed to be able to sell it at the higher price. In fact, your strike price up in here, which means you'll profit from here, but of course it's a binary, so it's all predetermined, but whatever, right? And if you're wrong, you would lose money up here, so you're not obligated to buy that at a lower or at a higher price and lose the difference. It's just the cost of buying the right to the lower price, if you meant. Well, Buzz, the numbers, as you heard, came out mixed. Pretty okay initial jobless claims, and a pretty bad PPI. So really nothing happened. They offset each other, in my humble opinion, and some market participants are simply rebalancing their portfolios. Some think the number, if you're looking at jobless claims, you're pretty happy. If you're looking at PPI, you're pretty disappointed. I like to call that clear as mud. So nothing changed. Okay. Probably people that wanted to sell before we get to 115. Okay. But still, if I wanted to sell this, I would still want to see like that. But I'm ultra conservative. So for example, let's say, where was I? So my examples, I said I would short here, right? And they should use binary op. If I was wrong and this went up and up and up, potentially I could lose all my money. If I never got out because of floating losses, and I just hold it like Euro USD is supposed to come down, it keeps going up and up and up. I'm exposed to unlimited risk. Because you know you're supposed to get out, right? But what's the cliche? The cliche is that there's that don't get out. And they can't get out now because they'd lose $1,000. So then it goes up and now they're losing $2,000. But they certainly can't get out now. Right? And then what? Then it starts going in their favor for a little bit. Now they're only 1,500 and they're like, oh, thank God. And then all of a sudden it's minus 2,500 and they're like, oh no. And then what happens? I'll double down. Now it's 5,000, right? So on and so forth, right? It's a cliche, but we all know it happens. Unlimited risk. You can lose it all. Theoretically, Euro USD could go up forever. It could go to 2.0 if it wanted to, right? With a binary, you say, look, at that price, I'm going to risk $25. And if I'm wrong, I lose $25. If I'm wrong by 1,000 pips, you lose $25. What if you lose 1,000 pips on a mini lot? You lose $1,000. Not 25. Okay? So you want to be aggressive. You want to sell the Euro USD. You just don't want it to go above 115 for whatever reason, the reversal pivots and all that kind of stuff. Start with the binary. Because if you're wrong, it doesn't cost you very much. If you're right, you know, you only make 83% return on investment. It's not huge, but you only have to be right 1 pip. Now, ideally, you're right 20, 25 pips. That's cool. But there have been times when I'm right 12 pips, but I still get paid for 25 pips. Okay? So just imagine it like a scalp. that you don't have to manage. You don't have to manage it. There's no stop to move. So you don't sweat bullets and all that kind of stuff. Because not only are traders, amateurs generally bad at technical analysis, but they're even worse at managing their trade, right? If it's a good trade, they move their stop way too quickly and get out at break even. If it's a bad trade, they don't move their stop at all and they take a huge loss. Okay? Demeter, not today, okay? Too off topic for now. So anyways, PPI was the bad number, guys, and I would think that this could still go up. Okay? This was muddied by a good jobless claims, but that's not enough because we're not looking at jobs anymore. I don't think the Fed really cares about that at the moment. We're looking at inflation, and negative PPI is not inflationary. Okay? So again, I would look at that and say no imminent hike at the Fed. So there's the DAX. We did the CAD. Whoever asked for the CAD, is that self-explanatory where we are? I would trade it like this. All the way up into there, or clear break, retracement, sell. But right now I'm a slightly more of a buyer than a seller, but that doesn't mean anything. If it falls, I'm going to sell the retracement. Okay, I'd look to be short in here. I'm not telling you to be short here because what you're saying is I bet it's going to fall. Well, you wait till it is falling and then you sell it. Doesn't cost you that much. Any other requests? Oh, give me a ticket for an aeroplane. How can I help you? Yeah, candlestick patterns. Sure. Do I pay attention to things like and you call that like a pregnant feral cat pattern or something? No. There are people that sell books $200 that have 2,700 different candlestick patterns. Okay, that's ridiculous. Okay, but the number one thing in technical analysis is support and resistance. If you don't have this, or if you don't have this, then everything you talk about is just a waste of time. Because whatever your strategy is, you're out of position. So like a pattern like a head and shoulders pattern. People tell me, Wayne, what about the head and shoulders pattern? And half the time it doesn't exist. But they see the pattern. But they'll see a pattern in a range-bound market, and I'm like, well, that's a reversal pattern, but we're not in a trend, so what is it that you're reversing? Oh, but blah, 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 blah. It's worthless nonsense. So there are basic things you need to know. Where's the support and resistance? What are the market conditions? In a range-bound market, use oscillators. In a trending market, use Fibonacci. Just very basic things like that. And then, I would say to analyze market conditions, whether you're trending or not. And either way, whether it's trending or not, or trending, you still need to identify levels of support and resistance. And if you can't do that, you're probably going to fail. How do you know it's a trending market? Trending market is a series of lows, lower highs, lower lows, lower highs, lower lows, lower highs, lower lows, lower highs. That's a bearish trending market. And a bullish trending market is higher high, higher low, higher high, higher high, higher low, higher high, higher low, higher high, higher low. If it's not doing that, in contrast, it's high, 100% retracement, 100% retracement, 100% retracement, then it's not higher lows or the opposite. Okay? If you happen to be at support or resistance, then candlestick patterns are important. If you're not at support or resistance, your analysis is worthless. And I don't care what your analysis is, it's just, you're not at support or resistance, it's not relevant information. Yeah, Eric, some people use two Bollinger Bands combined as support and resistance. Does Gerald Appel do it that way? Gerald Appel is the inventor of the Bollinger. Oh, no, sorry, John Bollinger, sorry. I was thinking McD for a second. Obviously, John Bollinger invented Bollinger Bands. He doesn't use it that way at all. But you can tweak anything to your liking. But Bollinger Bands measure volatility relative of candles. I'm not going to do it. We're well past the 75 minutes, Wyatt, so maybe it's some other time. But just be careful. There's lots of people selling you nonsense. You ever feel that way? That they got some really cool system that works 40% of the time? If you've ever seen Anchorman, right? 60% of the time, it works every time. Hey, look, I use 5 Bollinger Bands. See how cool this is? You should buy something from me. Just be careful, guys. So what I'm trying to tell you is look at the market conditions and make a decision. Is it trending or is it not trending? Regardless of that, you're going to need to understand where the support and resistance is. Then I would like you to learn price action. And price action very often will include candlestick patterns, but do you need to know that? No. Let me just, very quick thing on price action. Lower high, lower low, lower high, lower low. What's the trend? Lower high, lower low. What's the trend? Now, what's the trend? sideways. Okay? I'm already going to look at the distance between this low and that low as future support. So now I think it's going to do this. Is it going to break out? How would I know? I don't even care. Okay, and then what? Notice this time we didn't make a low. So now I'm going to assume a retest this old support. And I'm going to buy the dip because now I'm a bull. And if you were looking at this on, let's say, a daily chart, this is probably a year's worth of price action. On a 1 hour chart, you're going to see reversal candlestick patterns at these levels. And my favorite is the simple one, and it's in almost every reversal pattern there is. It's where you know, let's say you get high. Now I'm going to look for a higher low. Okay. Right in here. And that you'll see that in all kinds of patterns like head and shoulders patterns and stuff. So really, I'm trying to make it simple. You don't need oscillators. If you can't make a decision ahead of time, then these are worthless. So I want you to, again, write this down. I want you to look at the market. Is it trending or is it not trending? So in this case, for a very long time, they were simply buyers of the bottom, sellers of the top. For about 3 months. Easy. Easy, guys. The time before that, we were buyers of dips. Easy. Okay? Then, one day, we broke out low. And I was super crisp. Notice that there's no moving averages on this chart. Okay? Was I shorting in here? No. But we were ready to sell somewhere between the 3A to 6A Fibonacci retracement and with the roll reversal. Then it fell. And we rinsed and repeated until, what? Are we trending? No. So what's my behavior now? Just like I showed you before. Buy at the bottom, sell at the top, and a breakout, one way or the other, is going to change me from a range-bound trader to a trending trader. And that's why my advice was, if it drops, sell the rally at the old support, or have it go up here, in which I will try to sell, unless it breaks higher, and then I'll buy the dip. Okay? The rest is just more. But I don't think you need more, unless it's pips we're talking about. But I don't want you to make more pips at the expense of risk. I never, ever, ever, ever. How'd you know it was going to break? And I mentioned this, I might have been in the book, I used to mention it all the time, but my theory is that most books and guru presentations you've read or participated in is just some guy rehashing some nonsense that he read in some other guy's book and some other guy's. Now, I'm self-taught, so the little bit that I do read or the presentations I've seen, very often include information that is just wrong. But that's what he was taught, and the other guy was taught, and the other guy was taught, and it all began with some idiot that can't trade worth a damn, but decided to sell some books or some DVDs, and that's how he made his money. So, one example of that is, I don't know if this is still taught. I used to get this all the time from people coming to me for help, where they would wait for one full candle to close outside of the range and then sell. Have you ever heard that one? I don't know if it's still taught. Maybe finally the world has woken up. So let's do it this way. So this is an hourly candle, so you get a break like this. Oh, can't sell that one. Then the next candle is like this. And now you sell down in here. Because now it is absolutely confirmed the breakout. And do you know what absolutely happens in my experience? That. Now you take an amateur that makes amateur mistakes on top of that. Now, first of all, someone taught you to sell 2 red candles. I never sell red candles. I never sell red candles. I never, ever, ever, ever sell red candles. Because it's late. You're late. They already happened. Okay? So you've been taught to do something improperly right off the bat. And then, okay. And so what I look for is a break, a pullback, and I'll sell up in here. Okay? Now, the amateurs that first of all read some bad advice in a book, waited until it's way too late. It's already moved 70 pips. Now they sell. And of course, does the typical amateur trader have a 100 pip stop loss? What do you think? No. So 2 hourly candles forming a breakout, probably 100 pips. Or let's say 70 pips. And for those that sold in here and in here, what percentage of those traders would take a loss? I'll give you a hint. There was a study done several years ago, like 8 or 9 or 10 years ago, by I can't remember who, so I can't cite anybody, but that 85% of all the stops were within 30 pips of current price. So with that knowledge, every single trader, an amateur trader that sold down in here late, every one of them lost money. Okay, every single one of them. Certainly 85%, but very few would have 90 pip stops. But you'll need them if you're selling after the fact and you're late. You're going to need that. Oh, you put a stop up here. Okay. But I like price action type stops, Ron. Okay. Like if I sold in this upper blue one, which I said I would have, and it makes a higher high, I'm out. Very often I'm out. Because my trade plan was this. That's all. Yeah. But you could have it up here and say, well, you're trying to like an overnight type trade or something like that. Okay. So I'm self-taught, and I'd never seen that ever work. I've never seen this work, never. And yet it's common knowledge, and it's taught, and every amateur knows it. What they're not told is they need at least 100 pip stop, and we know that based on people's account size, that if they were to mini and that was $100, that would probably be 10% of their entire account, and they're not going to do that, right? So most traders are inexperienced, underfunded, and over-leveraged. This is why I teach you to get rich slowly, guys, with as little risk as possible while over time growing your trade account and lowering your risk. And I hope you see that that's because I want you to succeed and I care of you. And so does TradersWay. But they like this message. They want you to trade successfully for years and years and years, and that you're a loyal client of TradersWay.com. That's not a bad thing, huh? So it's now 9 o'clock. I think it's been 90 minutes. I should probably pull the plug in this one. I'll see you at FX Street tomorrow. Let's get one average. If you can, I'm going to drop you onto youtube.com/c/tradersway. And please leave a comment. Yesterday's video and today's video will be uploaded probably in less than an hour. You'll have access to it. Take care, everybody. Bye-bye.